There have been many ways to play the data center energy scarcity trade: nuclear energy for the long term, power management chips like Navitas, and energy-efficient cooling solutions like Vertiv for the immediate. Today, we're going to cover Tecogen, a company introduced an innovative cooling solution that runs without electricity. The biggest constraint right now for data center buildouts is needing significant amounts of electricity to compute and to cool the chips. Up to 35% of power consumption for a data center is tied up in just cooling. The reason for that is the chillers utilized today are operated with electricity, regardless if air cooled or liquid cooled. This scarcity in energy also is projected to get a lot worse, as by 2030, electricity consumption should double, especially as NVIDIA's AI chips become more powerful each iteration. To deal with this energy shortfall, there are two options. Either slow down the build out and don't use NVIDIA's latest, most powerful chips, or find a way to reduce the cooling consumption of electricity. Tecogen has a solution available right now to reduce coolant with electricity, and this is that their chillers are operated with natural gas. The 35% of electricity consumption used by coolant today can thus be available for compute with drop-in replacements from Tecogen. The best part of all is Tecogen isn't some new unproven startup like Oklo for nuclear small modular reactors. No, they've been in operations for over 25 years and have shipped over 3,200 units to non-data center customers. To get into the data center industry, Tecogen has formed a partnership with global leader in cooling solutions, Vertiv. Vertiv is going to cross-sell Tecogen's natural gas chillers and even help manufacture if the time comes. Having this partnership with Vertiv is a huge testament to Tecogen's natural gas technology. As for Vertiv, to really support Tecogen, who is a competitor, they must have seen the risks if they were not involved. Okay, so we have established Tecogen's natural gas chillers should be a huge cost and capability benefit for data centers. How are the sales? Currently, they have one data center developer who has signed a letter of intent with them. Obviously, this is not game-changing news, but Tecogen has also met with NVIDIA, AMD, and the hyperscalers to present their solution, which has helped Tecogen realize that their product fit is best as a hybrid solution. Natural gas operating for peak demand saving and electricity for the rest. They've taken back these learnings and have made their main offering a hybrid natural gas and electricity chiller. The main reason orders haven't been placed by the hyperscalers yet is the hesitancy to try a new technology for such a critical function, cooling. Even though the cost and scalability benefits are massive, there needs to be rigorous validation requirements. A data center can never be down for any reason, especially for these hyperscalers. Tecogen is just requesting a chance at a small trial order to be able to land and expand, as having just a single site for these hyperscalers place a full order with them will be $30 to $50 million in revenue. This will over double their current revenue of roughly $30 million today. Now, Tecogen is a speculative play. They have the product, but they need a hyperscaler to take a chance on them. If they did receive such an order, here's what I can see Tecogen's valuation becoming. Revenue-wise, they will maintain the roughly $30 million in non-data center segment business, as a lot of that is services on past projects. A 200 megawatt site install will net them about $30 million if half those chillers were their hybrid natural gas chillers. So they would roughly have $60 million in annual revenue with reoccurring high margin service maintenance revenue. From a price to sales, they currently trade at a 7 price to sales multiple. However, securing an order from a hyperscaler validates their technology and likely won't just be a single site, so I believe the multiple expands to 25 price to sale. This valuation will quickly compress as multi-site arrangements actualize and their revenue skyrockets. Nevertheless, with a single site signed with them, this would give them a valuation of $1.5 billion, magnitudes bigger than their valuation today of roughly $200 million. This is still lower than Navitas' $2 billion market cap now, which They help that their power management chips can also reduce energy usage in cooling. Valuation-wise, this stock has 10x potential with just a single site order. Until then, though, I do expect there is a strong narrative that can move the stock. As with all these small cap growth companies, the cash burn rate is important. They have $14 million of cash with a few $1,000,000 in receivables. They also have zero debt. Currently, the cash burn rate is about $2 million a quarter, so current cash position should last about 2 years. This is actually not too bad, as they've already developed the product, so just need to continue validation efforts for these hyperscalers to hopefully gain acceptance. 2 years is a good amount of time for this data center build-out cycle to hope that a site will be willing to take a chance on them. The second variable that I think matters more is Vertiv's involvement. Vertiv is selling this product for Tecogen and will eventually help them manufacture it as well. Should the validation data be perceived positively, why wouldn't Vertiv just acquire Tecogen outright now to add this technology to their cooling systems portfolio? It would be the best way for Vertiv to stop this technological competitive threat, but also give a nice stock return for Tecogen shareholders. This is a fascinating speculative play with strong fundamentals that can support the valuation too if they were to receive a PO from a single site. Let's run it now through mine and John's framework to determine if we want to add Tecogen to our portfolio. Before we do, please read the disclaimer in the notes below. We are not financial advisors and anything we say should not be considered financial advice. Also, if you like content like this, please click a like and subscribe as we aim to analyze the most innovative companies twice per week. Now let's run Tecogen through my 5-point framework. From a leadership perspective, I give this a strong. Their CEO was previously the CFO and has been with Tecogen for roughly 10 years. I respect his approach to partner with the leader, Vertiv, to break into the data center circles versus trying to get at it alone. In all his press conferences, too, he speaks measured and pragmatic about data center interest, which is a nice reprieve from the constant hype and pump other small cap CEOs have done. From a valuation perspective, I give Tecogen a neutral. Their growth is dependent on a single binary outcome, and that is winning a customer order from a hyperscaler. If it does, this stock easily 10x's if it's not acquired by Vertiv first. If it doesn't, then $200 million market cap for a barely profitable company doing $30 million in revenue is overvalued by my approximations by 70%. For revenue and profit growth, I also give this a neutral for the same reason. It is all dependent on them receiving an order in the data center space. It is positive, though, that a single site's order is enough for them to be profitable. For total addressable market, this is a strong. The data center cooling market is expected to grow from $20 billion today to $51 billion by 2030. This is a company doing $30 million in revenue today, which is less than 0.1% of the potential market. Lastly, for secular tailwinds, I give this a strong. The AI data center build-out has surged to record highs in 2024 and has now beaten that in 2025, with no indications that a slowdown in CapEx is imminent. Eventually, the CapEx needs to slow down, but for the next couple of years, this tailwind remains amongst the strongest. Overall, Tecogen scored quite well in my framework. They have a strong leader and a product that is solving a scalability problem for data centers at a cost benefit. That alone makes a small cap a worthy speculative stock. However, I'm a no to add Tecogen to our portfolio. This stock may still soar on any interpretations that they will receive a big customer order. However, the biggest variable that concerns me about this stock is actually related to Vertiv. Vertiv agreed to partner and cross-sell Tecogen's chillers 9 months ago. My personal belief is that since then, Vertiv has gathered market feedback from the data centers regarding likelihood of customer orders. And if Vertiv sees real interest, I do believe that they would have already acquired Tecogen outright by now. A $200 million company in Tecogen is a drop in the bucket for the $70 billion Vertiv. Again, this is just my hypothesis, but if Tecogen is not, quote, good enough for Vertiv to acquire them now pre-customer orders, I don't want to bet my money on this. What do you think, Dad, as you run Tecogen through your framework and technical analysis?
Thank you, Scott, for that wonderful analysis and presentation. Okay, today I'd like to do my framework for Tecogen, symbol TGEN. Okay, for the fundamentals, the dividend has no dividend. The beta is 1.18, which is surprising because it seems like it's pretty volatile, but anyway, it's 18% more volatile than the S&P 500. The market cap is 200 million, and it says the earnings comes out on March 16th. So for that, it's a neutral. And then for the earnings history of the last 4 quarters, it beat three of the last 4 quarters. So that's a neutral to positive. And then for the financials, the gross profit margin is 38%, but that's a little deceiving. But anyway, it's burning, as Scott said, it's burning $2 million per quarter, and only has like a 2-year lifespan. So, and debt to equity is 4%. So that's, and has no PEG ratio. So for that, it's a neutral to negative. For the technicals, the 200 is positive slope, it's open positive. The 50 is above the 200. Price is above the 200 but less than a 50-day moving average. Bollinger Bands are a little wider than usual, so that's a little bit more volatile. The slow stochastic oscillator is 31, which is neutral. The MACD is neutral, as is, and the unbalanced volume is negative. So for that, it's a neutral. And then for analyst coverage, it has one strong sell, one sell, and 2 buys. And one of the analysts thinks it's going to go to 15, which I don't know. It's their opinion, not my opinion, but it's their opinion. So let's see what happens with that. And then institution is 25%. So overall, Scott, I'm a no. I would like to like this stock. I like this story, but I just can't see how that it can make it in the hyperscalers, the cooling market of that. I know it may have a partnership with Vertiv, but I just don't see how it can be relevant with hyperscalers. That's just my opinion. So, okay, back to you, Scott.
Thanks, Dad. We both agree that we would like to like this stock, as the product does offer a solution for the energy scarcity problem, which Navitas Semiconductor has benefited from offering a solution. However, we believe it's too much of a gamble right now, not a long-term investment play. With that said, thank you for watching. Please click a like and subscribe to follow us as we aim to cover the most innovative companies twice per week. Until next time, happy investing.